Hi everyone, my name is Simon Bishevich and I'm going to be talking about the government change in regards to the capital gains tax. And one thing that they've done is reduce the capital gains tax from 28% to 24%. So let's get to the detail to see what that is going to do for us. So what is capital gains? Well, capital gains tax is a rip-off tax. Sorry, oof, did I say that out loud? Well, yes, it is a rip-off tax. Let's be fair about it. It's like inheritance tax. You get taxed on you die after you've paid all your tax all your life. CGT is no different. You've paid tax to buy an asset and you get taxed again when you make a profit on it. I'm not sure I agree with that, but anyway. So property disposals, you've got CGT, so it's based on the profits you make. So sales price 250,000, purchase price 150,000. You might have spent £80,000 on a property doing it up. And they got a taxable gain of 20,000. And please don't comment about how rubbish this investment was. It was just an example. So here's £20,000 profit. How does it play out then for capital gains tax purposes? So we've got three columns here: 6th of April 2022, 6th of April 2023, 6th of April 2024. And what you can have is your gross value of 20,000 minus your CGT annual exemption, which in year 2022 was 12,300. So 20,000 minus 12,300 gives you 7,700, which is a gain. 2023, the CGT annual exemption drops like a stone and hits you on the head. And you have this 20,000 now minus 6,000, which means you've got a higher taxable profit of 14,000. But the HMRC are not happy. They want to get you even further. Apparently, they want to help the housing shortfall and get people to own their own home. But what they're trying to do is then say, well, we're going to reduce the CGT annual exemption. Okay, that really helps the housing stock, doesn't it? So anyway, 20,000 minus 3,000 gives you a taxable profit of 17,000. Now, totally contradictory to this, if you look at the CGT rates, what's happened is that the government in the last budget said we're going to reduce capital gains tax rate from 28% to 24%. Okay, someone tell me how that works, because what they've done is that CGT annual exemption falls from 6,000 to 3,000, but hey, we are going to reduce the rate of tax to 24%. It's just left hand, right hand, do not know what they're doing. And I think Jeremy Hunt just didn't look at that and thought, yeah, that makes no sense at all. What we should do is leave the annual exemption alone or increase it back to 12,300 and tax people at 20%, just like everything else. People are going to be incentivized to sell their property, buy-to-let property, and we are potentially lowering the house price, which makes it more affordable for people to buy homes. Totally just don't understand what they're doing. I'd be interested to know what you think. So as soon as Conservatives are out of power for good, the better. And I can't believe I'm saying that. Anyway, so CGT, 18% across the board. If you're a basic rate taxpayer earning circa £50,000, you'll be paying 18% capital gains tax rate, which is different to the 10% if you sell any other asset. But for residential property, it's 18%. And you can see tax bands there from different tax years. It's going up. The high rate tax band is 28%. So if you are earning more than £50,000, you pay 28%, which again, you can see the amount of tax is still going up. And the reason why it's still going up, even though the CGT rate has fallen from 28% to 24%, is simply because they're reducing the CGT annual exemption. Okay, so they've got more tax out of you. Whoopee-doo, good for them. That's probably the last swan song for them, don't you think? Anyway, in terms of Conservatives, so good riddance. So here's capital gains tax. Some of the mistakes that you want to avoid. So the first one is incorrect sales or purchase price. When you have a completion statement, that is your legal documentation. It shows you all your facts and figures. What I've seen in the past from our own clients, as well as when I'm doing ad hoc tax consultations with people, is that they tell me the sales price and then they tell me a purchase price, which is a round number. And what that means is that they can't remember. and therefore they've forgotten about the stamp duty, land tax, or the legal fees. Everything associated with purchasing that property could be an extra cost, but because they have just taken an approach of they can't remember, or they're just rounding the numbers up, I think it's circa this, which is probably lower than what it actually was, they're paying more tax, and you should avoid it. So make sure you get your completion statement of sale, your completion statement of purchase, and get your numbers to be identified. For getting purchase and sales fees, so again, they will be on your completion statement, but again, one of the things I do see, people forgetting stamp duty, land tax on purchase, the legal fees on the purchase, the sales agent on the sale, the legal fees on the sale, all those fees, they just say, oh, well, shouldn't I just look at what I've sold it for and what I bought the property for? No, the CGT is based on the fees as well, so please don't make that mistake. Not reducing other income streams. Now, what I'm referring here, especially if you own your own business, is they sell a property and then they carry on taking the maximum amount of wages, maximum amount of dividends, which means they're a high rate taxpayer. But if you play your cards right, you could say, well, actually, I own a limited company, but I'm going to lower the amount of dividends I take because my gain is going to push me near the high rate tax band, but not over it. So you could do some real good analysis to help you reduce your tax liability, but people don't. They take on the same wages and dividends, have this huge CGT, which they don't need all that money, and now they're paying tax on it. And they could have played that a lot more straightforward. Not getting tax advice before you sell. People come to me and say, oh, I've sold a property, what can I do? Too late, the horse is bolted. You really need to do this before you sell a property and get some tax advice. How to reduce it. So basically what you want to do is sell before or after these two. So capital gains tax, how can you reduce it? And there are three main strategies I'd like to share with you. First of all, we know that the tax changes are coming into effect. So CGT annual exemptions are going to be lower in terms of the amount, 6,000 to 3,000 tax-free money. That's not good. CGT rate, yes, goes down to 28% to 24%, but don't be fooled. The exemption is what's going to cost you more money. So it's really a bad marketing ploy from the Conservatives to get you to sell your property later on. So it doesn't work. Second thing is sell strategically. Use your CGT annual exemptions every year. If you've got multiple properties, then make sure that you phase them over different years, get your CGT annual exemptions. You could even sell a property on the 3rd of April in this tax year, and then another property on the 7th of April, which is the following tax year, and therefore you're getting 2 lots of CGT annual exemptions. Really simple strategy to deploy. Not many people do. Couples use deed of trust. Now I see a lot of examples where there's a high rate taxpayer who has a property in their own name, married, and their stay-at-home mum, stay-at-home dad doesn't have any income. What they should have done is use a deed of trust to pass most of the asset to them, which allows them to utilize their CGT annual allowances and be on a lower tax band of 18% versus the new 24%. So straight away, there are lots of things that you can do to reduce your CGT when you sell a residential property.